One of the sad realities of business and investing is the occasional financial scandals and frauds that emerge. That's one reason for investors out there to stay aware that there are unethical people and companies that are willing to lure everyone to their wicked web. If the offer is too good to be true, that's the wake-up call for stepping back and finding a decent investment. Today's financial scandal is amongst the biggest in history and illustrates some of the ways unscrupulous people can defraud investors to enrich themselves. Bernard Lawrence Bernie Madoff is an American financier who executed the largest Ponzi scheme in history, defrauding thousands of investors out of tens of billions of dollars over the course of at least 17 years, and possibly longer. He was also a pioneer in electronic trading and chairman of the NASDAQ in the early 90s. How in the world would a man go with a crazy load of cash for a span of 20 years without being caught? Madoff's Ponzi scheme was a classic, and horrifically simple. It was operated through the wealth management portion of his business. It worked just like that, attracting investors and promising them extraordinary high returns on their investments. However, when investors handed over the money, Madoff just deposited the cash into his personal bank accounts at Chase Manhattan Bank. He paid returns to earliest investors, using the money obtained from later investors. Clients' trading statements showing their alleged profits were utter fabrications. Two other unsolved riddles around Madoff's Ponzi scheme were when it began and how he managed to go undetected for so many years. Some former Madoff employees claimed the scam extended as far as back as the 1970s, and the fact that his funds appeared to generate steady returns with low volatility meant he had a steady flow of new capital flowing into them. Very few investors ever withdraw their money, so he was able to maintain the illusion for a very long time, despite claiming to generate large steady returns through an investing strategy called split strike conversion, which confuses even the pros, but let's put it the simplest way possible. The split strike conversion strategy Madoff allegedly used involved a combination of stocks and options, and according to various sources, Madoff bought 30 to 35 stocks from the S&P 100 index. He then bought put options on the index at strike prices below the market's current level, and sold call options above the index's current price. An option strategy called collar is the simplest version of Madoff's split strike strategy. With a collar, you buy a put option that lets you sell your shares for a set minimum, no matter how far share prices fall. To get the cash to buy the put, you also sell a call option giving someone else the right to buy your shares for a given higher price. And by choosing the right options, you can set up the collar so that the proceeds from selling the call pay for the put you buy. Essentially, the net result is that rather than facing the possibility of a total loss or having the opportunity for huge gains, you limit both your potential losses and gains to a fixed range. In reality, Madoff never used such complexities. He simply deposited clients' funds into a single bank account that he used to pay existing clients who wanted to cash out, and funded redemptions by attracting new investors and their capital. In 1999, financial analyst and accountant Harry Markopoulos had informed the SEC that he believed it was legally and mathematically impossible to achieve the gains Madoff claimed to deliver. It took him 4 minutes to conclude that Madoff's numbers did not add up, and another minute to suspect that they were fraudulent. After 4 hours of failed attempts to replicate Madoff's numbers, Markopoulos believed he had mathematically proven Madoff was a fraud. He was ignored by the SEC's Boston office 2 times in 2000 and 2001. In November 2008, Bernard L. Madoff Investment Securities LLC reported year-to-date returns of 5.6%. The S&P 500 had dropped 39% over the same period. As the selling continued, Madoff became unable to keep up with a cascade of client redemption requests. And on December the 10th, according to his account, Madoff confessed to his sons Mark and Andy who worked at their father's firm. The afternoon he told them all, they immediately left. They went to a lawyer. The lawyer said, "You gotta turn your father in." They went, did that, and then he never saw them again. Bernie Madoff was arrested on December 11, 2008. He has insisted that he acted alone, though several of his colleagues were sent to prison. His elder son Mark Madoff committed suicide exactly 2 years after his father's fraud was exposed. Several of Madoff's investors also killed themselves. Andy Madoff died of cancer in 2014, and Madoff the father was sentenced to 150 years in prison and forced to forfeit $170 billion in 2009. His 3 homes and yacht were auctioned off by the US Marshals. He is currently residing at the Butner Federal Correctional Institution in North Carolina. If you liked the video, make sure to subscribe and hit the bell to turn on notifications for more interesting financial stories. I'll see you in the next video. Take care.